Well, friends, today I want to talk to you guys. What am I thinking about 2026? So this was a question that was recently asked. So I thought, maybe I share it with all of you guys so that way we can, I don't have to respond to each individually on our WhatsApp group. 2026 is going to be an interesting year. So we can already see we are almost at the end of January, and we are already dealing with potential tariffs on Canada, potential tariffs on South Korea, and now we're also dealing with the funding issue, right? So the funding bill got passed. In the House, but most likely it will get rejected in the Senate now. Why? Because DHS funding issues. We had a couple of killings, and Democrats are seriously upset about that, and they want to remove DHS funding out of that, and they're even demanding the head of DHS, Christie, should be fired, or they are going to impeach her anyway. So that's what we're seeing right now in January, and I think that's going to continue throughout the year. We're going to see all kind of situations happen. We might run into this midterm elections, and who knows, there might be other tariffs, there might be other situations that will arise. We still have a Iran issue that is still not resolved, and President Trump, you never know, there could be a lot of different things. So my goal today is to kind of focus on a bigger picture, so that way we don't really panic out of things and kind of try to understand the risk and reward going into 2026, what is happening. So that's the purpose of today's video. So I hope you're going to get some value out of it. And if you do, please like, subscribe, and comment onto the channel. And if you're not already part of my WhatsApp community, then certainly consider doing that. Send me a message. Let me know you want to join, and I'll be happy to add you to that community. I do a lot of meetups, try to meet with people in person and talk about different things. But before I begin, let me remind you guys, I'm not an investment advisor, so I'm not here to tell you what to buy, what to sell, when to buy, when to sell. Not my cup of tea. I'm a tax advisor. So if you need some help with taxes, reach out to me. Go to taxcodeadvisors.com. If you don't know me already, you can set up a discovery call, get to know me better. What do I do? How do I work? All that kind of good stuff. If you need some consultation, then set up a consultation appointment. Sometimes people set up a discovery call thinking that would be a consultation. Please try to understand, we don't get paychecks from anywhere else. This is our business. This is how we get paid. So do set up a paid consultation appointment if that's what you're looking for. And there are different ways to do that. You can do just a regular hourly consultation. You can do comprehensive consultation, or you can enroll in a coaching program that includes free access to me throughout the year anyways. So those are a few different options. Having that said, let's take a look what's happening in 2026. S&P 500 is up roughly 77% since October 2022. So that is quite high. Normally, within the 3-year period, we would be up about 30%. So 77% is more than double that. Now, this doesn't mean that market is about to crash tomorrow, but historically speaking, normally when we have this kind of upside, we will typically get some sort of a downside, maybe 10%, 20%, 30% correction at some point of time. We don't know if that will happen in 2026. Maybe it happens in 2027. Nobody really knows. So I'm seeing a lot of speculation out on social media, on YouTube and Twitter and all that there can be crash. And I think I saw Tom Lee talked about it as well. So he mentioned that most likely he's expecting a bear market sometime this year. Truth is, nobody really knows. Maybe we get it, maybe we don't get it. So I would not really make my decision just based on that information. The truth of the matter is, we've been up for 3 years. We've been up a lot. So it makes sense if things cool down. But do they have to cool down? Well, let's talk about it. Number one, we are in an AI infrastructure boom cycle. Almost $500 billion is projected to be spent in 2026. I mean, how can I expect markets to completely crash when we are having that kind of spending? 280 billion of that will be spent from mega cap tech alone. So I can really count on that kind of spending. So this is real capex backed by real earnings. And obviously, it is giving us real growth. Take a look at the growth projections for 2026. Market is expecting 15-16% growth now. Is it realistic? I don't know. I think it's too high. I mean, last year was kind of different. Last year, expectations were low, but the results were high. This year, expectations are high. Let's see where the results are going to be. We'll find out after the first quarter earnings. But so far, that is what market is expecting. But one thing I do know for sure, and this has been reaffirmed again and again by mega cap, they are continuing to spend. I mean, just take a look at what Meta is doing, right? When it comes down to AI, we don't really even consider Meta a big player just yet. Our focus is on Google Gemini or OpenAI, some of those companies, but we are completely ignoring Meta. And Meta is building a lot of data centers. They're doing deals after deals. They want to really spend into business. So We can kind of see this real capex that is driving the market right now. Number two, interest rates. Right. So Federal Reserves has cut interest rates multiple times, and now market is expecting them to cut minimum 2 times. And if we get a dovish Fed, that's what President Trump wants. If we get all of that, now I don't know saying we will, but let's just say we do get all of that. Now, what are we seeing? We're seeing lower rates, cheaper capital. That means higher spending and more profit. And then again, there's a lot of political pressure from President Trump as well, although that might change as the midterms arrive. We'll see how that goes. But again, so far, that is what market is expecting. And then, retail investors, we saw that last year again and again. Every time there's a dip, retail investors step in and they are buying. They have, I think different time frames, different kind of message becomes popular. So, for example, a few years ago, people start investing in index funds. And that has been going on forever. Like when people are investing in index funds, they don't look at the valuation. They don't care whether stock is up or down or, if there's a good company or bad company. They don't look at it. They just simply buy the index fund. Simple as that, right? Similarly, what I'm seeing now, a new trend happening in the market where a retail investor doesn't really care about companies. If people believe that this is the direction we are going in, like, for example, the direction is we're building a lot of data centers, then everybody jumps into data center. If the direction is that, hey, there's a lot of demand for memory, everybody jumps into the memory. If people see OpenAI is going to go public for $1.5 trillion, then all of a sudden, every company that is in the space domain becomes attractive to retail investors. So those are the driving factors in the market. Corporate buybacks, I don't remember the exact number, but they're probably responsible for like 40% of the growth that you're seeing in the stock market. Like a company can choose not to do buybacks. They can give you dividends, but they don't do that. What do? They buy back stock. What does that do? That brings more people who wants to own that stock. It just increases the price. So if the goal, let's say if the general goal is to bring the PE down, because that's what, when people talk about valuation, that is the one focus everybody has. Hey, the PE is all-time high, right? Sometimes it's 23, sometimes it's 26, sometimes 28, whatever the number might be at different point of time. Doesn't matter. But all I'm saying is, if corporates, if we have a law, for example, and President Trump sort of briefly talked about it, that for security companies, hey, don't do corporate buybacks and don't give out dividends and reinvest that money back into the business. But similarly, let's say if he comes back and say, hey, no more corporate buybacks. If you're going to give the money, give it as form of a dividend. You will see that market will cool down right away because of that. Right? Because people most likely are going to reinvest those dividends in a different way. So these corporate buybacks is actually responsible for a lot of growth that you see in our stock market, not necessarily the retail investor or corporate investor. I'm not saying to ignore them. I'm just saying that is one big factor. I think buybacks alone is well over $1 trillion. So I think the main reason for that is because a lot of compensation for executives in the companies these days is based on stock price. I mean, I think Elon Musk's case was very popular a few days ago. A lot of talk about that, but it's not just him. Pretty much all the companies work the same way. Hey, if the stock hits this price, this is what you're going to get. So why would they issue a dividend? Most likely, they are going to do buybacks. Another one is, hedging and options. So this has become really popular these days. And you guys know I run a coaching program. So a lot of time people reach out to me and they ask me, hey, do you also talk about options? I'm not a big fan of options because that means the moment I'm getting into an option, I'm not really thinking long term, right? I'm really thinking about short term. I want to buy a company that is a small plant today that can grow into a big tree a few years down the road. That's what I'm looking for. And if I'm, hedging myself and protecting myself all the time, then obviously I don't believe in that company as strongly as I would like to. But again, that's just me. A lot of big companies or the big whales or sharks, whatever you might want to call them, or market makers, I think that might be a better word. They use hedging all the time. They use call options by buying stocks. So obviously more calls means more buying means higher prices. I think recently in our WhatsApp group, I was talking about Nancy Pelosi. She have recently bought a lot of options. And that's not just her. A lot of big guys do that because they want, in one way to think about it, options is a leverage stock because you're able to buy so much more with little capital. obviously we're seeing a lot of that as well. But that worries me because in a downturn, that works against us, that the stock prices can fall really, really harder. And I think I would expect that to happen. Things will be a little bit more volatile. Valuations are high, but they've been high for a few years. And because of all the underlying reasons I said, I would not really sell out a market just because of valuation, because they can be just like that. I mean, take a look at the PE. PE has been more or less stable for last few years, even though stock market continues to go up. So the question we must ask today is, what would actually crash a market? There has to be some sort of trigger, right? And I'm not talking about like a trigger like what President Trump does, meaning some sort of news. Although market does sell off, but then it quickly recovers because market, quickly realizes that this is not a long-term impact. So things I would be worried about is labor market. That is my biggest fear. Unemployment, although still stable, but it has been slowly rising. And as we know, we've been talking about that K-shaped economy for last couple of years now, and that is just continues to get worse. So if that trend continues, at some point, there will be lower spending. There will be falling earnings, at least for many companies. And at that point, Federal Reserve might be too late to the game, to get things back on. Now, I think probability of that happening is less. What I'm really more worried about is stagflation. That is perhaps the worst case. That means we still have growth. Why? Because of all this capex spending, all the rich people, all the people who are inheriting. You have seen the real estate prices in our country. They're still super high, and people are still getting older. So what happens with this real estate? This is getting inherited by the younger people. So there are a lot of rich people in America. These people continue to spend. I mean, at the Wealth Summit last year, I kind of showed you guys one example, right? 2 casinos, both in Las Vegas. One is doing extremely well, other one is not. Why? Because they cater to a different client. And you can look at the same thing over and over. You can look at into housing. For example, I was looking at the housing market in Austin. You take a look at expensive homes. Those homes are still a 7% year over year up. But if you take a look at, let's say, starter homes or medium-sized homes, they're actually down. So we're starting to see more and more of that. So that means if this continues, we might run into this stagflation problem. That means we're going to have slow growth, we're going to have a rising unemployment, and we're going to have a sticky inflation all at the same time. And when that happens, what are the choices Fed actually have? Because think about whether it's President Trump or some other president at that time, doesn't really matter. But the problem is, what do? We have no option but to print more money. And if we print more money, we are inviting more inflation. We already have record deficits. We are already printing a lot of money. We cannot even pay our interest payments in this country. You can imagine what kind of scenario that would be. But seems like that's where we are heading, unless this country has so much explosive growth in the last couple of years that we're able to get out of it. Now, my biggest fear for this year, for 2026, which I started out with earlier, is that a lot of expectations, and these expectations are very, very high. A lot of spending has been done into AI, data centers, and a lot of other developments recently. And now investors are saying, hey, show us the results. So just what if, earnings are not able to meet up with those expectations? What happens then? That means even if companies are able to meet the expectations, the stock price might not go up, perhaps even collapse. So, so that can be a big problem. And then think about the index funds, right? Let's just say if some of these mega caps come out and they are not really doing that well, and if they're able to start missing on earnings, I don't think they will, but I'm just putting a hypothetical scenario out here for you guys. If they do, 40% of those earnings in S&P 500 are coming from these mega caps. I mean, that is just going to drop the index, and it's going to hurt not just the mega caps, but it's going to hurt a lot of other companies as well. So those are some of the issues that we need to be watch out for right now. Like, how can you protect yourself going forward, right? Take a look at meme stocks. If meme stocks are flying high, a lot of people are buying them, though they keep continuing to go high. You're seeing a lot of crazy enough happening in crypto, and a lot of crappy companies are going public, stuff like that. If you see that, I would be more defensive. Then, if you start seeing people chasing growth, like they're not happy with 10, 12%, like in our WhatsApp group, I think Ronak Bhai has put up, hey, this year market going to do more than 10%. Honestly speaking, we should be happy with 10%. What if gold only does 10%? We should be happy with 10% is a good number. I know you might be saying, what, is that what you teach in coaching program? Not really. I mean, I teach people how to think about markets, how to think about companies, and how to take advantage of opportunities. But that's a different story. I'm just saying, as an investor, we should be happy with 10%. If we're chasing growth, we want 40, 50, 60% growth. That's when things they put us in a lot of trouble. We end up making a lot of silly mistakes. Okay, so don't try to chase that kind of growth. Margin debt is already high, and it can possibly go high a little bit more. I think it's maybe another 20%, 30%. So I think last time I checked, it's probably close to about $1.3 trillion. So if it gets to around 1.6, 1.7, somewhere around that, I'll start to get really worried right now. And maybe we should come up with some sort of a law to keep this margin debt under control, because this puts us in a lot of trouble. I would say focus on um, focus on your plan. So, for example, in the coaching program, what I talk about is usually there are few stories that are playing around. Right? Like, for example, right now, space is a big story, data center is a big story, memory is a big story. And in these stories, you have maybe 2 or 3 key players. So if these stories are long-term trend and you believe in that, the easiest thing to do is treat it like an ETF, and you dollar cost average into it slowly, because they're long-term stories. So who care what price you bought? If a story is going to work out over 5, 10 years, if it's a growth story, then that's okay. Second thing is always have some cash handy. So when market goes up, let's say your portfolio is up maybe 20%, 30% or something like that, book a little bit of profit and put that money aside so you can buy it when the market drops. This is a big help. A lot of time we ignore defensive companies altogether. So think about utilities, consumer staples, healthcare, although healthcare is struggling right now because President Trump is not so much happy with it. But I would really not be on opposite side of President Trump. I'll rather stick with the trades that he likes. But my point is, you need to have some sort of defensive position that can help you withstand just in case there is any kind of a downturn. If you're on margin, margin can get you in a lot of problem because it really plays with your psychology. You're not able to think straight. So if you are into margin, then be very, very careful. Say eliminate it altogether. But if you don't want to eliminate it, maybe put some sort of stop losses, at least on those 2 or 3 trades where you're heavy in margin. So just in case things go the other way around, you're out of them and you at least don't have to worry about the margin. At the end of the day, I'll just say, have a plan for 2026, like how you're going to play this market. I think it's going to be a great year. I'm not bearish at all. It's going to be a challenging year, just like any other year. It's just going to have a different sets of challenges, but it's going to be a great year. So I'm not so much worried about it. I think we're going to make money this year, but we have to be careful. We have to plan things, and stick with your plan. Once you have the plan, you can always change your plan, but know what the plan is, what kind of plan you have. For example, you guys all have access to our planner, right, that we gave away at the Wealth Summit. And if you don't have one, reach out to me. Maybe at the next meetup, I can bring one for you. But in the planner, the idea was that we listen to a lot of ideas, a lot of thought process. I mean, you probably got some good ideas out of this video itself. And then we think that we know it. But in reality, all we did was we consumed. Maybe you watched this video for 15, 20 minutes and you consumed a lot of content, but you didn't really learn anything out of it. The only way you're going to actually learn is when you take a piece of paper out and you write down some of these ideas that I talked about. Some of these risks, some of these opportunities out there. And what are you going to do? What is your game plan if market drops by 10%, 15%, 20%? If you're worried about some stocks, then hey, if this happens, you should know who your weak players are. Right? If you're playing any kind of game, you know who your weak players are. Maybe those are the players you want to get rid of as soon as you see a first sign of stress in the market. So that way you don't run into any kind of trouble. And now you have plenty of cash. So if market does drop, you'll be actually happy because you are prepared to take advantage of that dip. Once again, guys, I'm not an investment advisor, so I'm not here to tell you what to buy, what to sell. Just want to give you some good ideas that you can think about investing in 2026. Once again, if I can help you with taxes, reach out to me via taxcodeadvisors.com. If I can help you learn about investing, then reach out to me and ask me about the coaching program, and I'll tell you all about it, and we'll go from there. All right, I'll see you guys next time. Thank you.